Hi there, and welcome to our video on Iron Condor, the fastest way to grow a small account. Today, we're going to take a deep dive into what these options trading strategies are and how they work, specifically for beginners. Let us take the detailed knowledge about Iron Condor. The Iron Condor strategy is constructed by selling an out-of-the-money OTM call option and an OTM put option, while simultaneously buying a further OTM call option and put option. The goal is to generate a net credit premium received when initiating the trade. By selling the two options and buying the two options, traders create a position with limited risk and limited potential reward. To implement an Iron Condor, traders start by selecting an underlying asset, such as a stock or index, on which they want to apply the strategy. They then determine the desired range within which they believe the underlying asset will trade until expiration. This range is typically defined by choosing two different strike prices for both the call and put options. The Iron Condor strategy is commonly used when traders expect a period of low volatility or have a neutral outlook on the market. It profits from time decay, theta, and a decrease in implied volatility. By selecting strike prices that define a specific range, the strategy is designed to profit if the underlying asset remains within that range until expiration. However, it's important to note that the Iron Condor strategy also comes with potential risks. If the price of the underlying asset moves beyond the strike prices of the bought options, it can result in a loss. Therefore, it's crucial for traders to carefully manage the position and monitor market conditions. Example of Iron Condor. Suppose you are an options trader and are interested in trading options on a stock called XYZ. XYZ is currently trading at $150 per share, and you have conducted your analysis, indicating that XYZ is likely to trade within a specific range over the next few weeks. With this information, you decide to implement an Iron Condor strategy on XYZ. You assess the price range you believe XYZ will stay within, determining that it will likely trade between $140 and $160 until expiration. This range will define the strike prices for your Iron Condor. 1. Bear call spread. You sell a call option with a strike price of $160. By selling this call option, you receive a premium, which represents your potential profit if the stock price remains below $160 at expiration. To limit potential losses, you buy a call option with a higher strike price, such as $165. This higher strike price is farther away from the current market price of XYZ and acts as a hedge in case the stock price rises above $160. 2. Bull put spread. You sell a put option with a strike price of $140. This generates another premium, representing your potential profit if the stock price remains above $140 at expiration. To protect against excessive losses, you buy a put option with a lower strike price, such as $135. This lower strike price serves as a safeguard in case the stock price falls below $140. Now, let's explore the potential outcomes. If the stock price of XYZ remains between $140 and $160 at expiration, all four options in your Iron Condor will expire out of the money. The sold call option and sold put option will expire worthless, allowing you to keep the premiums you received when you initially sold them. The bought call option and bought put option will also expire worthless, but acted as a protective measure to limit your potential losses. You keep the net premium received from the initial trade as your profit. If the stock price of XYZ rises above $160 at expiration, the sold call option will be in the money, potentially resulting in losses. However, the bought call option you purchase at a higher strike price provides a hedge against those losses, limiting your overall risk. The sold put option and bought put option will expire worthless since they're out of the money. Your loss is limited to the difference between the strike prices of the call options minus the net premium received. If the stock price of XYZ drops below $140 at expiration, the sold put option will be in the money, potentially resulting in losses. However, the bought put option you purchased at a lower strike price serves as a protective measure, limiting your potential losses. The sold call option and bought call option will expire worthless since they are out of the money. Your loss is limited to the difference between the strike prices of the put options minus the net premium received. Managing the position throughout its duration, adjusting or closing it before expiration, and closely monitoring the stock price of XLEZ are important steps to effectively implement the Iron Condor strategy. This helps ensure that you protect your profits and limit potential losses. Fastest way to grow a small account Iron Condor strategy. 1. Start with proper capital allocation. Determine an appropriate amount of capital to allocate to each Iron Condor trade based on your risk tolerance and the size of your account. It's generally recommended to risk a small percentage of your account on each trade to ensure that losses are manageable. 2. Choose liquid underlyings. Focus on trading liquid stocks or indices with options that have tight bid-ask spreads. This helps ensure that you can enter and exit positions at favorable prices, minimizing slippage and transaction costs. 3. Select optimal strike prices. When constructing an Iron Condor, choose strike prices that offer a high probability of success. Consider using options with around a 30 to 35% probability of expiring in the money. This helps maximize the potential credit received while keeping the risk controlled. 4. Manage risk diligently. Implement strict risk management practices to protect your account. Set predetermined stop-loss levels based on the maximum loss you are willing to accept for each Iron Condor trade. If the position reaches this level, exit the trade to limit further losses. 5. Diversify and manage positions. Avoid putting all your capital into a single Iron Condor trade. Instead, diversify your trades across different underlyings and expiration dates. This helps spread the risk and reduces the impact of any single trade going against you. Monitor your positions regularly and adjust or close them if necessary. 6. Take advantage of high implied volatility. Iron Condors benefit from high implied volatility as it increases the options premiums, allowing for larger potential credits. Look for opportunities when the implied volatility is relatively high, such as during earnings announcements or significant market events. 7. Learn from experience. Keep a trading journal to track your Iron Condor trades, including entry and exit points, reasons for initiating the trades, and lessons learned. Reviewing your trades can help identify patterns, refine your strategy, and avoid repeating mistakes. 8. Continuously educate yourself. Stay updated on market trends, option strategies, and risk management techniques. There are various educational resources, books, online courses, and trading communities available that can help you enhance your knowledge and skills. In conclusion, the Iron Condor strategy is a versatile options trading strategy that allows traders to profit from a stock or index that is expected to trade within a specific range over a period of time. By combining a bear call spread and a bull put spread, traders can create a limited risk, limited reward position. The strategy aims to generate income from the premiums received when selling the options, while also using further out-of-the-money options to limit potential losses. However, as with any investment strategy, it's important to do your research and consult with a financial advisor before making any decisions. We hope you found this video informative, and we encourage you to like, subscribe, and leave a comment below with any questions or feedback. Thank you for watching, and we look forward to bringing you more informative content in the future. And we'll see you in the next video.